Hey guys, this is Greg coming in with another Fundrise video. Today we're going to be talking about Fundrise's Quarter 3 2021 performance. Fundrise themselves have put out an update. I'm just going to go over that article with everybody and kind of just put my own little thoughts in there as I'm reading through it. So if you saw my Week 8 update, and I really strongly suggest you go back and check that out, you saw that I had a huge increase on September 30th when Quarter 3 ended of about $40 just on $350 invested, which is kind of a big deal. I mean, just to go in 8 weeks and see that kind of return is kind of amazing as an investor, and I hope that you guys are seeing that as well. That going into real estate and investing in it is really beneficial for you in the long run. Now, you won't see some kind of increase like that all the time, but just to kind of see that as an investor is great. I mean, there might be some negative, quarters in there that you may have to dredge through, but just to see that, that's kind of an amazing thing. Before we go on, though, I just want to ask you, please, if you like what you're watching, please make sure to hit that like button, and please make sure to subscribe, because you're going to get videos like this on a weekly basis from me, just going over some features that are in Fundrise, some updates as they post them on their website. And there may be a couple of other things sprinkled in there during the week that you guys can kind of see. So without further ado, I'm just going to go in and talk about the Quarter 3 updates here from Fundrise. So as we can see, Quarter 3 2021 performance update, a quarter of remarkable results. As I said, if you look at my portfolio, and I've just started, it's a huge increase just in the quarter, in a partial quarter for me. And it's really cementing to me that I'm going to be keeping on investing in this in the future as the years go on. So here's an in-depth look at some of the factors that gave them this near-term performance. To paraphrase Hemingway, mega trends happen gradually, then all at once. So in this case, while the notably strong performance of the portfolio over the last quarter may feel sudden, it was in fact many years in the making and the results of a number of different factors rather than a single event. So in Quarter 3, several of our funds, driven mainly by the equity investments in residential assets, experienced a level of price appreciation that is uncommon in the world of real estate. In some instances, certain investments saw quarter-over-quarter price appreciation at a property level in excess of 50%, with our balanced and growth-focused funds reporting NAV increases over the last quarter ranging from 0.59, so 0.5%, as much as 20.91%. And there's an asterisk there. I'm sure there's something down below. We focus specifically here on our balanced and growth strategies because it is those funds that derive these returns primarily from asset appreciation, and as a result saw strong results. All told, performance over the last 90 days, that's the quarter, for any appreciation standpoint was arguably the strongest we've experienced since the inception of the Fundrise platform. So that's a big deal. So this is the strongest they've seen since the beginning of Fundrise, this last quarter. Okay. Today, our conviction about our general investment thesis is as high as it's ever been. However, it's worth calling out that this type of disproportionate performance over a single quarter is not likely to be repeated. So they're just saying, hey, guys, we saw this huge jump. Don't look for this next quarter. Don't look this down for the next year. This may just be an anomaly that we're seeing. And this is just, we're pumping our fists. We're happy. But don't get it too excited. Today, our conviction... Oh, I'm sorry, I read that. This isn't to say that we do not expect to see strong performance going forward. In fact, quite the contrary. Investors who have been with us for a while will be familiar with the refrain that we seek to identify and invest behind large macroeconomic trends precisely because we believe these trends are likely to drive outsized growth, which in turn can deliver better than average performance. Of course, investors who have been with us for a while will also be familiar with the refrain that such success is never guaranteed, and all investments carry risk, which could lead to a loss. So just like I said, you may see a big quarter like this, you may see a loss one quarter. That's just what you do. It's the risk being in the game here with real estate. Instead, it is recognition of the fact that a fundamental advantage of being a long-term investor is that we do not have to attempt to time the market. Rather, we can be patient, designing and executing strategies to allow those trends time to play out at their own natural pace, and ensuring we capture those rare moments with a confluence of factors come together to bear truly remarkable fruit. So here are the details. As mentioned above, while the broader portfolio of our various funds saw positive overall performance, the primary contributor to the outsized returns came from equity investments in the ownership of well-located, affordably placed residential properties. So more granularly down on that, they saw outsized rent increases caused by post-pandemic spike in demand combined with ongoing limitations on the supply of housing. There's just a huge lack of new housing coming out, and that's really driving up those prices. So accelerated Sunbelt growth, whereby the existing dynamics of strong population and job growth that we've discussed previously here amplifies. And you've seen me talk about this in the videos that I'm showing on the interval fund, because that is the Sunbelt. That's where they're investing in the interval fund. Huge growth down there. And you'll see in the 31 properties so far that as of the date of this recording, I'd say 98% of those properties, minus one warehouse in the Northeast area, Atlantic area, it's all Sunbelt. Okay, Texas, Florida, that kind of stuff. So they're saying here that the Sunbelt amplified by the pandemic-driven migration of both people and companies into that region. So the increased institutional demand of well-located, cash-flowing residential real estate assets paired with the record low interest rates and compressing cap rates return expectations. Again, although most of these trends have existed for several years and are likely to continue for the foreseeable future, the pandemic has created a unique inflection point resulting in what otherwise may have been 10 years of gradual change being condensed into the span of 12 months. So what they're saying is you're seeing 10 years compressed into 1 year. Okay, so the graph above shows the surge in residential apartment rents that have occurred over the past 6 to 12 months. You see that really huge surge there. Okay, while the below image demonstrates the cap rate compression, or in other words, the lower overall return demanded by the market for the same assets. So falling cap rates and discount rates result in higher property prices, all else being equal. So you can see that here throughout the last couple years. So looking ahead, we continue to believe that many of the same macro trends that we've been focused on over the last few years will continue to be dominant drivers of growth going forward, while a few new pandemic-created norms will likely also have an impact on our investment strategy. Specifically, we believe that the Sun Belt will continue to outperform. The same tailwinds that have driven so many price appreciations in the region over the past year continue to exist. Population growth, job growth, housing affordability, warmer weather, demographic shifts, and now with remote work seemingly here to stay, we believe the area is only that much more likely to attract new residents who otherwise would have been tied down on jobs such as New York, San Francisco, Los Angeles, Washington, D.C., and the list goes on. So remote work will permanently alter both office and residential real estate. We see technology-enabled remote work as a mega trend with parallels to e-commerce adoption in the early 2000s. More and more people will now have greater control over their time and increased flexibility over where they choose to work and live. As a result, we expect many people will choose to move from high cost of living cities with cold winters to low cost of living cities with milder winters. According to Redfin, the average single-family home in Northwest Washington, D.C. costs $1.5 million versus, for example, in Raleigh, where it would be $427,000. That extreme gap in value provides a compelling reason for a millennial family or retiring boomer to move southward now than they do without sacrificing their career. Fundrise, the company opted to shift to a remote first working environment during the pandemic, and recently completed a survey where we asked our team members if they would prefer to continue under that model or switch back to that traditional full-time in-office environment. More than 85% of respondents said they preferred either a majority remote or full-time model. We believe the long-term consequences of this playing out across thousands of companies nationwide will likely shift more and more value from traditional big core offices and apartment properties in dense urban areas to single-family homes in more suburban environments. So e-commerce will continue to eat retail. While this trend is nothing new, the move towards greater e-commerce adoption only accelerated over the past 18 months. Many customers who otherwise may have never considered shopping online for items like groceries or everyday household goods were forced to make the switch and now will likely never fully give that up. The same trend can be seen in data around meal delivery and other customer shopping trends as well. The end result of ever increasing online sales with the constant expectation for 2-day, 1-day, even same-day delivery means greater and greater need for well-located industrial logistic facilities. The rise of software technology as an integrated part of our physical space. Mark Anderson said software is eating the world, but until very recently the physical world and the digital world were very much separate. But a wave of new software tech such as AR, VR, voice commands, along with innovation in new and greater mobile and other hardware, so watches, rings, glasses, is starting to blur that line. Smart home systems cannot just control your thermostat or notify you when someone's at the door, but increasingly predict and prevent costly home maintenance issues or provide on-demand service solutions for everyday chores like house cleaning or lawn care. Mobile-only restaurants now exist where the entire brand and experience of the business exists only digitally, while the food is prepared in a ghost kitchen and sent out via a delivery app. For a long time, real estate investing and technology investing were two very different spheres, but looking ahead, the two may become increasingly only one world. So in summary, we're thrilled to see such exceptional returns over the past quarter. They are a testament to both the hard work of a team as well as the value of identifying the right macro trends. However, as usual, we also want to manage expectations. It would be a mistake to celebrate this performance without acknowledging that it represents years of groundwork previously laid out. The nature of great performance is non-linear. Sometimes it pops, sometimes it slows. The key is always to be making the steady progress. And again, while success can never be guaranteed, we've intentionally designed Fundrise with this idea in mind, making it possible for our investors to leverage technology and benefit from the opportunities that it can unlock over the long term. Again, I've been saying this over and over again. This real estate investment is meant to be a long-term deal. 5+ years. It's not something that you just want to, pop a couple $100 into and then next week say, you know what, I want that money back. That's not what this kind of system is made for. The interval fund itself makes it a little easier to do that. Every quarter you can pull money out, put money in, things like that. But for the main E-REITs, it's something that you want to keep that money in over a long period of time, just to make sure that your money, as it's ramping up and then it's bringing in more money, gives you the best deal overall. And while now it seems easier than ever to get distracted by short-term performance, i.e. this quarter, we continue to work every day to build on the foundations we've created, always preferring to be the tortoise rather than the hare. That's slow and steady, just like I've been saying. Over the next month or so, we plan to share a deeper look at some of the factors we believe are driving the overall growth of real estate investments, our assets, more broadly, and how we think about them in regards to our long-term investment strategies. So until then, onward. And right here we can see kind of the Q3 NAV increase from June to September, end of June, end of September. The interval fund was started at $10.79 on June 30th. That's about where I got in. I think I got in at $10.80, and the NAV is now $12.10. So that's a change of 12.14. And we can see down here that the growth E-REIT 3 has grown 20.91% in the quarter. And the lowest was the West Coast E-REIT, going up only a few cents, so 0.59%. That's what we saw up in the notes above. So I'm just going to leave that up there for a second, and just thank you guys for watching. Again, if you like what you hear and like what you see and want to keep watching it, please make sure to hit that like button. Like I said before, it really helps with that YouTube algorithm just to kind of get my stuff up there. And also, if you're interested, please hit the subscribe button, and you'll be able to see any kind of new video that I post out there. Like I said, I try to post 1 or 2 Fundrise videos a week. I'm looking at different kind of crowdfunding things like Ground Floor, maybe Masterworks, and I'm going to be looking at doing some kind of e-REIT, or I'm sorry, just REIT investing in something like M1 or Robinhood, just to kind of do a compare and contrast with something like Fundrise, just to kind of give everybody an idea of where it may be better to invest over the long term, or even if you want to do both, just to kind of have your own REIT investing in the brokerage account, and then also be putting money in Fundrise for that slower growth. So until next time, guys, take care.